All right, we're live. Welcome back, everybody. Let me send out the link a little bit and then we'll get started here. What's up, everyone? Is my sound good? Is my video good? If it is, say something in the chat. All right, let's share this link out and then we'll get started. All right, welcome back, everybody. So the other day if this is your first time seeing it, the other day we did a video on what the Ethereum upgrade means for hex stakers. There's in that video we talked about this upcoming EIP 2929 that's getting rolled out into Ethereum in April. And what this is going to do is it's going to actually make an impact on the cost of end staking a hex stake. And this is something that it's been a known issue. Like the Ethereum developer ecosystem has been pushing to increase this cost for a long time. And it was actually a big part of why the max length stake is 5,555 days, is because there was uncertainty about what the future cost of performing this particular opcode functionality with a smart contract on Ethereum. And so that's why the max length stake is 15 years instead of what I think was originally 50 years, was because of uncertainty about what that cost could be. And we're seeing it play out in real time. And so what I wanted to cover here today was to revisit something that we had done a video on this channel a couple months ago, where we were talking about what the minimum viable stake is. In that video, we were more talking about the cost of acquiring and staking the hex. We weren't really thinking about the cost of ending your stake. And now with this change, the cost of ending a stake is going to increase by about 3 times. And it's really relevant now that that's like a dominant part of the cost of performing a stake. I wanted to revisit that in more detail and then try to come up with kind of how on say on the hex.cash site, we have that chart where there's a line that shows if you're underneath the line, you're paying inflation. If you're over the line, you're earning inflation. I think something that might be helpful to add is either a new chart that indicates like a similar line where if you're above the line, you are, your stake is profitable. But if you're under the line, you're going to end up paying more in gas than your stake is worth. And so in that case, you would have just been better off just holding the hex liquid. And so there's going to be an important line to look at in the just like in the space of all hex stakes, where everyone above the line, for them staking hex is profitable, but for the people below that threshold line, a hex stake won't be profitable for you, because the cost of gas that we have to bear when you end a stake, it doesn't matter how much hex it is. It could be 1 hex or it could be 100 billion hex. The cost isn't like a per hex thing. And so, it's like a fixed number, and then the market sets like the price for that fixed unit of gas. So it doesn't matter how big or small your hex stake is, the cost is the same. And so it disproportionately impacts smaller players compared to the larger players. And we've already seen it happening where a lot, just like, when Hex launched, it was like pennies to start and end your stakes. But now that there's just so much other activity going on the Ethereum ecosystem, like if you think about it, when Hex launched, Hex was like the only thing using Ethereum, like, because before then, like, Hex was the first major use case of Uniswap, which is now like a dominant. Like, let's take a look at the Etherscan. Let's look at the chart of the gas. How do we look at the gas? Here we go. Let's take a look at the gas. So, like, look right here. Like, Uniswap now takes up 20% of Ethereum's block space, and followed by, two stable coins, and then followed by another decentralized exchange. So like routing through all the decentralized exchanges. So what that means is that, like, before Hex, like when Hex was early on, Uniswap was like a ghost town. Hex is like what pumped life into Uniswap. And so now that Uniswap is like a major force for global speculation, it is just it's eating up 20% of the Ethereum block space. And people and like what's unique about the trading protocols compared to other use cases that eat up a lot of gas, when you're sending Tether, you can usually tolerate some delay. Like if your Tether transaction doesn't get there on that first block, it's okay, because if it gets there on the second block 10 seconds later, it's not that big of a deal. And so, like, Tether, like the priority for Tether transactions, some people may have like an urgent, like where they need it there ASAP, if they're doing some type of like arbitrage trading or something else. But with Uniswap, in trading, especially with like the arbitrage trading that happens, that powers a lot of these like yield farming protocols, and where you're doing arbitrage, or you're like whether you're arbitraging price or you're arbitraging interest rate, in the use case of trading, priority transactions make a big impact. And so like 20% of all the gas is Uniswap, and then on top of that, people that trade on Uniswap, like, if you're moving $1 million, you're okay with paying a couple hundred or a couple $1,000s to make sure that your transaction goes that block, because that may be the time frame that you're trading on. And so, like now, like with this new reality, things like Hex, where the urgency to consume gas, it is it's not that high, because if you're starting a stake, like, yeah, you want to lock in your share rate on that day, but like you can put really low priority gas onto that transaction. And because like the mode of using Hex is like, okay, you lock your coins, and then 15 years later you unlock them. And so like like for the use case that Hex fulfills, you don't necessarily need to you don't really need to like gain that much priority. And so with these other use cases that just have like a higher like inherent demand for high priority transactions, it is really tough to compete for block space with those people, because like those people really they don't care what they're paying. But for smaller Hex stakes, it can really make an impact, especially when there's like not much like priority for like like for how quickly your start stake or end stake goes through. So like that's why like the prices of gas have just gone up so much, is because the things that use a lot of gas now are things that require really high priority. So like the market is willing to pay more and more gas to perform whatever transaction that they're doing. And since this is like a public good, like anyway, if you have the gas, you can do a transaction. we just gotta, that's just like the market we're participating in. And so that's definitely a big driving factor in a lot of the communities, how everyone wants to like roll out a new chain to avoid this. That's really what's like the motivating factor for those efforts. But the thing to keep in mind is that you pay for it in one way or another. And so, like moving to a new chain may decrease the like per transaction cost. But by being on a different chain, we're now further away from, the hundreds of billions of dollars of economic mass that exists on the Ethereum blockchain. And I think that, bearing the high cost of transactions, I think that may be something worth paying for, because when you decrease your transaction costs, you're like you're like increasing the cost in some other fashion. It's like you're trading like a financial cost for like an increase in risk, or you're trading the financial cost for like a decrease in like serviceable market. Because like by being on Ethereum, like, any Ethereum whale can just come in and double our price in a single, swap. But if, you're on another chain, you don't have that like ready access to those people, where the increase in the gas fee, like they do not care. Like just like generally like the increasing gas costs because of all the other activity that's happening, between the trading and now look, OpenSea's number 9, like with the NFTs, like there's even though the fees are going up, so is our price. And so, there may be some relationship there where just like, there's a reason people are paying so much for, these transactions, because, they're worth a lot of money. And, so like it definitely hurts smaller players, but for, what really what I think is probably like a good goal for Hex as, like an economy to have is, you're going to get what you cater towards. And so I think that's like the risk in trying to cater towards smaller transactions, is that's just what you're going to get. And the small players, they're not the ones doubling the price in a single purchase. Like the big players who aren't really impacted by a increase in the cost to perform a stake. Those are the people that really drive the price. And if you think about it, if the cost of increasing, or if the cost of ending a stake is now increased by 3, then all we need to do is triple the price. And a single Ethereum whale can come in and triple the price. And that person doesn't, they probably don't care about the increasing gas fees. Like, they're the ones pushing the gas fee up. Like, they're like, they don't care. And 2, they, if you have that much money, you may want it to be secured by a network that costs a tremendous amount to participate in. And so that is, the more I thought about it, that is one of the key risks involved in like a quick move to another chain, is that you're moving to a different chain for the pure purpose of lowering fees. It's catering to a group that's really not supporting the price. And so catering to the group that is supporting the price in a really big way, the people that can triple the price in a single transaction to make up for the 3x increase in the cost of ending stake, those people aren't necessarily going to be quick movers to a new chain. And so that's definitely something to keep in mind with like thinking of solutions to increased fees that are keeping a lot of people who really care about Hex, just like pricing them out of the market. And so that's certainly something to think about. But today, what I really wanted to go into was just trying to understand like what the minimum feasible Hex stake is. Because that's really like the key thing that with this change that you like need to be aware of. You know, like I've seen some people share some screenshots of their hex stakes, and it's just like, okay, you know, staking like 100 hex, you know, like a bunch of 100 hex stakes, and it's just like, you know, that's literally like a few dollars, and the cost of starting the stake, maybe at the time was only a couple cents, but you know, by now the cost of starting that stake or of ending the stake is now going to be hundreds of dollars, and so like, you know, you rather than spending $100 to end your stake, you just buy $100 of hex, like, because you know you're not going to need as much hex as you currently had, and in that case, like, you would have been better off just holding that hex liquid, even though you didn't earn the interest. You know, you at least, you know, maintained your principal and didn't have to bear any additional cost to unlock it. And so something that I want to really unpack here is just like this you know, just like this equation, because like now that the S load cost is increasing, it increased by 3x, and it could increase by more. You know, like what I've read about it is that like this has historically been underpriced, like relative to other types of these, like the cost of using different opcodes. Apparently, this has been historically underpriced. You know, like relative to the amount of like computing it requires, and just like other more like, you know, advanced things. And so now that this is like, you know, makes an impact in like, because hex relies on this heavily, you know, we should all definitely be aware of this, and then just have some, you know, just more tools at our disposal to be able to know, okay, I have this amount of hex, should I stake it or should I just wait and you know, so you know, or just hold it liquid, and you know, rather than looking for like a 40% increase per year, you know, from like interest you would have earned by staking, maybe you can still gain that you can still have that 40% gain by, you know, keeping it liquid and then having the opportunity to, like, you know, sell into a pump and then buy into a dip. And then maybe in the act of that, even though you know you have to bear the trading risk, you know, like that, you know, you in order to gain that same amount of hex, you know, maybe that trading risk is worth the cost to otherwise earn 40% more of your hex through staking. You know, so I think this is actually a really good thing for hex. Like, you know, as much as it sucks for like small people who really care about hex to be priced out of the market, you know, you got to look at, you know, like like as sad as it, like the small players aren't the ones that are providing that economic mass that can bring hex to number one market share, and so you know, I think that you know, it really, you know, like it how can I say this? You know, catering to that may not be the thing that provides the solution. You know, and the decrease in the increase in the amount of like the increase in the minimum feasible hex stake is really bullish for the price. And even though the interest earned on staking is like an awesome thing, it does come at serious costs. You know, like really, like, you know, there's no free lunch anywhere, and so you know, I think that, you know, that you shouldn't expect to be bailed out by a new chain. Like if you have a bunch of hex that's permanently locked forever, because, you know, it's like your hex stake is worth $20, but the end stake cost is going to be $200 of Ethereum. You know, you'll just get more hex by just putting that $200 of ETH into new hex. You know, like that like I don't think you should expect to be, like, you know, made whole by a new chain. I think that like the time to roll that out is really high, and you know, the market is demanding ERC20 hex. Like that's like why the price is so high, because like the market demands that, and the market may not demand, like, even if like there's like a 1-to-1 you know, like snapshot where where all the hex and all the shares are like ported over to a new system, the market may not demand that, because you know, like if you have like, $10 million of hex protected by the Ethereum network, and then now suddenly you have like, another amount on that other chain, you may, like in that situation, there may be more risk to holding that money in like a smaller, less proven chain that just has like less demand for block space, where those big people who don't care about the increasing gas cost. The increasing gas cost only benefits them because it prices out people smaller than them. Just like porting over your hex to a new chain doesn't guarantee the market will keep that price. And so for, as sad as it is, people with like really small stakes are, that's just the way it goes. Those are the risks in these things. You don't know what the price is going to be, and you don't know what the costs are going to be to interact with the chain. Like those are based on the future actions of people that you can't predict. And so, that's just kind of, that's just the way it goes. And, that's just what we'll have to deal with. So, really, I mean, the best way to really think about this is that you want the amount of hex that you're earning to increase at a faster rate than the cost it will be to end your stake. Because say to start, you have, 100 million hex. And, you want to stake it, but then at the end of your stake, you don't want to suddenly have less hex or have to sell ETH that could have otherwise been hex to cover your cost of performing the transaction. And so because the act of ending the stake, it requires, this cost, which is primarily driven by, this cost of calculating. So this is right here is so this is the cost of calculating your payout. That's what this S load cost times day is. And so let's see. Yeah. So that's what this part of the equation is. So that's the cost of calculating your payout. And then the second part of the equation is the second part is, let's get the text, how much, this is your hex opportunity cost. Or no, this is this is your cost in hex, where you're paying the gas price, which fluctuates with the amount of demand on the network at that time, times the current exchange rate between hex and ETH. So this is a measurement of what your fee is measured in hex. And so what you need is for the amount of interest that you earn during that stake, which is this over here. This is the amount of interest that you're going to earn on your, so interest earned on stake. So you need the interest earned on your stake to be greater than the cost of performing the end stake times the measured in hex, because the whole goal, the whole reason you stake is to end up with more hex. And so you need the amount that you earn to be greater than the amount of hex you could otherwise have by just buying the hex with that ETH, that you need to end the stake. Because if say you had, 1 million hex locked up, and it's going to cost, you 1 ETH to unlock it. And at that time, the 1 ETH can buy you, say, 200,000 heck, whatever the price is. If your stake earned you less than how much the cost to end it would just buy you at that time, you may think twice about, if the amount of interest plus your principal, if you could otherwise just get that much more hex by just buying it, you should just buy it, because you'll end up with more hex at that time. And so that's what this is like, really what I'm really hoping to kind of really figure out is what is this S load cost, and then how can we reason about what the gas price is going to be. So from my rough calculation, and just from what some of the other developers in the ecosystem have said, the current price of, let's see this right here. So the current gas cost per day is something around 1100 gas. So that's gas, and then the future, with the new cost is going to be 3 times the current, and so every day, each additional day is going to cost you, okay, let's take a look at, let's look at the gas station. So right now, let's just say the average is 150 Gwei. Current gas price, so this is the amount of the ETH, or the amount of Gwei per unit of gas, is, what did that say, 150, and that's Gwei. And what is, so Gwei to ETH is, I think, to the -8 or the -10. So 1 Gwei equals that amount of ETH. ETH to Gwei equals that. So let's, Gwei per ETH equals 1 over float. Okay, so ETH to Gwei, or Gwei per ETH, let's just sanity check ourselves here. Okay, yeah, so that's close enough. It's 3, 6, not, so it's 1 billion Gwei per ETH. Okay, that's right. And so right now at current prices, so the current gas cost per day equals, or times the current gas price. So it's 1650 Gwei per day. So this is per calculated day. So for a 1-day stake, you're paying 165, 165,000 Gwei. So if that is, so now we multiply that by the ETH to Gwei. So per day at current gas prices, each additional day that goes by, it's going to cost you 0.000165 ETH, hex, or ETH every day to calculate the hex stake. So if you have a stake that is 30 days, you're paying, so cost to end stake. So you're paying, let's see what that is in dollars. So like for a month-long stake, right now at current gas prices, it's going to cost about $10 to end. So not that bad, And so what that means is that like your principal plus your interest needs to be, greater than $9 for it to be like feasible for you to end, or else like rather than collecting that principal plus interest with $9 of ETH that it's going to cost you, you should just buy $9 of HEX from the market, because you'll get more HEX. So, so that's like, kind of like, rough rule of thumb. So say that's like a 365. Let's see what that does. So let's just like measure this in ETH. So like a year-long stake, you're going to need about 0.06 ETH times, so 0.06 ETH, so like that, like at current price, that's $120. So like another solution to this is that like if you have a stake ending at some period of time, using this kind of rough estimate, you can start to plan how much ETH you're going to need to end that stake. And if you like, say because like here's the thing, like this gas cost, like the thing, like it's like this thing is going to, so like that's for a current one. So let's before we talk about that, let's look at future gas costs per day. So like starting like, so for all ones moving forward, like this is about to increase. So like for that same year-long stake, right now you're going to need $361 of Ethereum at the current price in order to, for it to be, like feasible to do that stake. So like, that can grow to be pretty significant. Like if your stake is only worth like a couple $100, like you're probably going to be paying more in gas than what your stake is. And so, like you have to make the decision because, like if you can get more HEX just by buying more of it, then, you might as well do that because, like one, it pushes the price up because like if your stake ends, you have 2 years to end it. And so you have 2 years of opportunity where you're bleeding out 1% per week to hope that the gas price goes down, because like this, like the gas cost isn't going down. If anything, it's going up. Like this could be higher than 3 times what it's going from 700 to 2100. That could very well go up. But like, maybe other, improvements or like things moving to layer 2s make the gas price go down. Because right now, like, it's like 150 GWay, like per unit of gas, like some days it's really low. And so like what you have to measure when your stake is ending, and if you have a stake that's like on the cusp of being a little bit too small to reasonably end, you need to, like consider the fact that you may just want to like with that ETH, maybe just start buying some HEX. And then just like, keep some ETH available, in the event that you're, like either the value of the HEX goes up to make up for the amount you're bleeding out, or just like the gas price or the gas price goes down such that it becomes more affordable to unlock it. But that's probably what we're going to be seeing is that, people that, like with stakes that are like below this like minimum threshold, where like pretty much like for a year stake, the cost to end your stake is going to be 0.01 or 0.18 ETH. And so let's take a look at the HEX to ETH. Let's look at the price here. Let's zoom in. So like right now, like, like this ETH price in HEX is, like how many is that? 1, 2, 3, 4, 5, 8, So 5 zeros and an 8. So current ETH to hex is 1, 2, 3, 4, 5, 8. Is that right? It's 1, 2, 3, 4, 5. Yep. So right now you're like, if the current ETH to hex is that, then the minimum amount of, so cost to end stake divided by current ETH to hex. So like right now, like the minimum amount of hex, like to the principal plus your interest ending up pretty soon. If like at the current, but like, so this could change. So like as the price of hex goes up, say this like, a little bit more than doubles, then, like that minimum, stake size goes down. But say like the value measured in ETH goes down even more. So like say there's like a 90% bear market and like the value of ETH relative to the value of hex goes up 10x. So say we have like a 90% loss from here measured in ETH. This number is going to go higher, where like the minimum viable stake is going to go up. And so at the current price, so like right now, the current minimum viable year-long stake is one where the principal plus the interest is at least 22,000, 22,000 hex. So, like that's, so what is that in dollars at the current price? 22584 times 0.01, what's it, like 6? So right now that's like pretty much everything under $361 is probably going to be done. So like if you have stakes that are, about a year, and this only goes up. So keep that in mind. Like every day that goes by, it increases. So like that's like so say you have a 4-year stake. So that's like 1,200 days about. Let's go 1,300. Now your cost to end the stake is like 0.64 ETH. And so if like at the current price, this, like if the current price holds over the next 4 years, which, we don't know if it will, we don't know what this exchange rate's going to be, like that minimum viable hex stake becomes 80,000. And so, so current hex USD equals 0.01, what is it, 17? And then if we have the like minimum viable end stake is that, then so that minimum viable end stake times current hex USD, so that's about like $1,300. So even like people with like a couple $100 stakes, if current price holds here, so if like the prices of today like kept where they are, this minimum viable end stake continues to creep up. And so, this even gets into territory where like, someone getting 1,000, okay, so like, let's put it this way. Like if you're staked for 4 years and you're earning say, 40% interest per year, so that would mean that you're in total getting like 1,600%. So you go from, 1,000 to, so like so the interest, it's like even someone with like a couple $100 of hex right now, like they could get bled out permanently. So, like this really is going to creep up on people. And so, like what we're really hoping for is that like as this number goes up, so here, let's just do this all in one block. So days, let's go days staked. So here, let's just move all this into one. So days staked equals, let's see, like 400. And then we're gonna do this up here. Let's just run that. So now if we see what the cost to end the stake, yeah, so for a 400-day stake, like that's gonna be the cost. So like the other things that, that can drive this is like, okay, so say like, part of this, like our current, like these ones aren't going to change, but this current gas price, like say like the new things that Ethereum rolls out moves this down. So say like the gas price goes from 150 GWay to say like, 50 GWay. Now when we run this, that like cost and the stake goes down dramatically. So like this is like a big driver in this, is like what the gas price is. And that's the thing that fluctuates based on demand for the time. And so like if Uniswap moves to a layer 2, like we should at least see a 20% decrease in that. If the stable coins move to layer 2, we should see like an additional 10%. So like that, like this can really, continue to drive down, and it's like the other things that are like eating, like all these contracts, like, who knows what they are, but like as layer 2s and like other scaling solutions start to emerge, that really helps us. So I think that will really be our saving grace, is like you want this gas price to go down. Like this, like the gas cost is always going to go up, but the gas price could decrease over time. And so like the things that we really want, so here's what you want. You want gas price to go down. You want hex price to go up. You want ETH price to go down. You want hex APY to go up. Like these are all the things that will help decrease this cost to end the stake, and then bring this like minimum viable end stake down. So let's take a look at hex.vision, and so say like let's just like assume that all current prices are going to remain the same for the next year. So the gas price remains the same, the hex price remains the same, and the ETH price remains the same. And so let's take a look at hex.vision. And so what this means is like let's just call the minimum viable end stake with everything like remaining the same. That minimum viable end stake is going to be 8250 for a, let's say for a 365 day stake. Your minimum viable end stake is, let's make sure that this is right. Oh no, okay, so at current prices, minimum viable end stake, which is the interest, so principal plus interest. So let's take a look at this. So we're not going to count big payday here. So like what we're going to search for are, let's go to the stake one. We're going to look for ones where they started after big payday. So November 19th, 2020 to now. So these are all the ones that started. So let's view when they start, when they end. Okay, so we also want ones that haven't ended yet. So we need to make end doesn't exist. Okay. And we need to see, okay, so what else do we need to know? So let's actually just look at which one, like we can estimate this by looking at what the daily payout is. So like kind of going back to this, like the average daily payout times the share days. So share days is number of shares times days staked times this average daily payout. So like since big payday, the average daily payout, let's just look at this. So like it's around 5.9, 5.6, 5.7, 5.8. Okay, so it looks like it's hovering around like 5.8. And so let's just say that the average daily payout is 5.8. We're going to look at all the stakes that end, between where the expected end, let's just add that. So we're gonna look for ones where the staked days. Okay, let's just add that to see what these values are before we. Okay, so staked, we're gonna look for ones where staked days is less than 365. Okay, so these are all the stakes that started after big payday and are only lasting a year. And so let's do this. Let's actually just we'll even further zoom in. We're going to look exactly on the ones that started after big payday but have lasted for a year. And then we are going to look at the number. Okay, so we're going to also add a filter where what was that minimum threshold that we calculated? 225,584 is the minimum. So what that means is that for those ones that are earning 365, so 365 times that average daily, which we saw to be 5.8. So these people are earning 2117 in interest per share. So the number of shares required to earn, okay, and so if the interest rate is 40%, so we're going to say that for our just this filter we're going to make, so the principal is going to be 60%, right? No, so if we have, the principal times 1 point, whatever the interest is, so the principal times 1.4 is going to give us that. So we're going to have that divide, so minimum viable end stake, so minimum viable end stake divided by 1.4 should give us what the principal is going to be. So let's just see what the principal is. Okay, yeah, so this is a stake that started with greater than 16131 and has so that's what the principal is going to be. So that means that this stake needs to end. So let's look at minimum viable end stake minus principal. All right, so this is a stake that had 16,131 hex to start, and then earned 6,452 in interest. So what that means is that they had that divided by days staked, so days staked times what the average daily payout, so that 5.8. So let's take a look at this. So this person had 3.048 shares. So we're going to find all of the stakes that had less than 3.048 shares. And this will show us, if our math is right, this is going to show us a list of all the claims that are of this type. So these are only the ones that staked this amount of days. We're going to see how many of them are getting priced out. So hex shares is going to be less than, here. And hex shares is less than, here, let's see what this unit is denominated in. I think you divide by, you divide by 4. So hex stake shares is greater than, or no, less than that. So we need to multiply that by 10,000, just because I know how the units work on staking on that. So Let's see how many ones are priced out here. So there's actually, if my math is right on how these shares work, there are 962 stakes that are going to be priced out. Let's see what the hex stake is. Oh, no. Okay, so here's the other filter. So, and hex staked is less than 16131. So like the principal is less than 16131. So there's 500 so far. There's 564 stakes already that are. Let's see if we can look at some of these addresses on GraphX. So like, there's already 564 only on this, like ones where like the stake days is 365. So let's do, let's say that this is like a close number, like, you know, plus and minus like some band of days. So, so let's just say where the staked days is going to be stake days is, okay, here, we'll have this in a different filter here. So staked days is in between, let's just say 300 and 400 days. That'll give us like a good estimate of like how many people. So there's actually 1,300 stakes that are probably going to be left better bleeding out just from this sample. Like this sample of like, you know, because like as the number of days grows, the number of minimum grows, but then like you're earning more interest per day. So like, you know, we would have to adjust that. But like just for this quick off the back of the envelope estimate, there's going to be about 1,400 stakes that are just going to be better off bleeding out because the cost to end this, like, you know, for this person is going to be, you know, like you're just not going to make it back. So let's take a look at like just this random address. Let's just look at GraphX. Let's just kind of get a sense of this. Okay, yeah, so this person has one stake for 8. They only have 0.8326 T shares, and they staked 12,000 hex. So this is, you know, like a small person, you know, maybe testing out the waters. You know, like this person is going to be paying. So their stake is how many days did it say? 326 days. So this person was 326 days, and then so that puts the minimum viable end stake principal plus interest at 20,000. They had 12,000 hex to start, and then they had 0.8326 shares. So that person 0.8326 shares times 5.8. So they're earning 4.8 hex per day times days staked. So they earned 1,500. So like at the end so what did we say that they had to start with? 12,158 plus 12,158. So this person in total, the value of their stake is going to be about 13,000 hex, and it's going to cost them about 20,000 hex to end the stake at current prices. You know, these can change. So, you know, it's just an estimate, but like this person, you know, with that amount of, so they would need to, you know, so like divide that by the current ETH to hex, and we're going to see how much, or times current ETH to hex. So this person is going to need about 0.16 ETH in order to to end their stake. This person, rather than using that 0.16 ETH to reclaim 13,000 hex, they should just use that 0.3 or that 0.6 ETH to buy 20,000 hex. So if you get what I'm saying here, like this is like there's a lot of people that have. So let's export this. Let's see what we can. So we're gonna look at the. See if we can. Let's do a visualize. Let's see. Okay, so the y-axis, we're going to make it a, let's just look at the maximum. This is going to be the date histogram. Let's see what that gives us. Okay, no, so we're going to do a sum of the hex staked. So pretty much everyone below this line. Well, so like, okay, so let's see, let's do the, what's a better way to do this? I think if we increase so let's make this by day. Or actually, no, let's do count. Here's what we need to do. We need to do a count. So like all these people are just going to bleed out, sadly. And so like here, what I wanted to do is we need to see what the sum is. Update. And then we're going to just increase this to be like a yearly thing. And then this should give us if we're right, so sum of the hex staked. So right now what this means is that there's about, 5 million hex staked there, 5 million there. So there's about 10 million hex that is set to be like that normally would have became liquid. So plus the interest earnings, so say it's 40%. So say it's about 15 million hex that was set to enter the market that is now permanently locked, where these 15 million hex, like these people can either gain those hex by paying more than what they're worth to end stake, or they can gain that hex by taking that amount of ETH and just buying more hex on the market. So at the same time, there's an amount of hex that is, rather than coming on the market. So here, let's take a look at when the expected end is. This will give us a better way to look at this. So like, this hex was expected to end during, the next year. But now, like, as this person bleeds out over the 2 years from 2022 to 2023, when these are bleeding, those hex that would have became liquid on the end stake date are now being split up pro rata amongst all of the stakers. And so like that whole like share chart looking 15 years in the future, those hex, rather than becoming liquid now, are going to be becoming liquid later. And so it delays inflation, and it makes these people make a business decision. Are you going to just let your hex bleed out, or are you just going to buy some more hex? And so like all those people that that want that hex, they may just end up buying more hex. And so at the same time, where like there's a supply crunch where less people are able to mint their hex, those people that would have paid something to mint them are now just going to use that ETH that they would have used to unlock their hex. They're just going to go and buy more of it. So it's like double pumpamental. Like, as sad as it is for these, what do we say, like 1,800 people that have 15 million in hex that they're not going to be able to realize just from this subset of people. Like that's only looking at like this group of people. Extend that out to like, the people that are, like longer days, like just spreading this out over the whole spectrum of, from short stakes to long stakes. Like there's always going to be people that are just not going to be able to afford to end their stake. As sad as it is for those people, that's super bullish for the price. Like this honestly may be the most bullish thing in Hex. The fact that that they're increasing this gas load cost from 700 to 2100. As sad as it is for the people that won't be able to end their stakes, this may be the most bullish thing that's ever happened in Hex. And so these are just kind of the things to kind of keep in mind. So let's take a look at the chat, see if anyone had any questions. And Boom Baby sounding good, volume is straight. Good morning. Yep. Vogel says this is why an airdrop from Pulse should come about, and it should only go to stakers. Like that very well could happen, but that requires there to be demand for the Pulse that makes that good. Either way, like it's really hard to just like capture that, because the thing that people are demanding is the hex, the hex that is on ERC20, and just because you get something else to try to make up for it, like that would mean like in order for it to like make up for it, that would mean that like whatever thing you got in the airdrop would need to have that like an equal amount of demand to the thing that you had lost, which is like hard to recreate, right? Like there's already demand for Hex. The people that are putting demand on Hex, they don't care about this increase in gas cost. Like it benefits them. Like it really benefits whales relative to smaller people. So this is going to be really, but you knew from the start longer pays better. You didn't know why longer would end up paying better, but for people that are in that that shorter term stake where they're not benefiting from the getting 3 times as many shares, because like if you have like a 1 year stake, like you're getting a little bit more shares, like 20% more shares, but the cost of ending the stake went up 3 times. But people that are getting that longer pays better, like the full longer pays better, where they're getting 3 times as many shares, like to them, like they're already keeping up with this increase in this cost. So like anyone in like that like 1 to probably 5 year range, they're really going to get like where you haven't at least doubled your, because at 5 years that's when you double your shares per hex. So the people in that 1 to 5 year range, small stakes in 1 to 5 years, like that's really going to suck for you. Like let's see how many of those people there are. So staked days, this is going to be edit. So let's just say 10 days to, what's 5 times 365, like 1550, roughly. 16 million, 12.8 million, 7 million, so that's 10 million. So it's 26 million, 30 million, 32 million times the interest that those people are earning. So say over that they average, so it's between 1 and 5 years. Let's just call it 2.5, or let's call it 3. We'll just for our easy calculation. So 3 years times, say they're earning 40% per year, so 120% on top of this. So what do we say? That was like 30 million. So 60 million, and then like say another like quarter of that. So, or say 30% of that. So like 30 million, 60 million, plus another 10 million. So about 70 million hex is going to be permanently locked, because they're going to be under this threshold of, let's say let's just to make this estimate a little bit. So let's treat it like the 500 day. So now this minimum viable end stake is now 30,000. And so if over that, say half is principal, half is interest, then what's the minimum? So let's just say this now goes to 20,000, because longer days, this is just estimate, but longer days means higher. So 21 plus 17, so that's almost 40, plus another 10, that's almost 50, plus 7, that's like 50 and a half. So like just about like 55 million times 2, because that's like what they'd be earning. So about 100 million hex is going to be permanently locked if the current prices remain the same. So that's a lot. And so say it's like 50, say it's like 100 million times 0.1065. That's like $1.6 million of hex that is probably going to be infeasible to end stake. And so what that means is that all these hex that aren't going to be ending stake, they're getting paid to the big staker, the people who have longer pays better and just more hex to start with. This is going to, this is really going to gas up. Like if you have a lot of hex from early on, this is really going to gas up your ROI. And if you're a big player that you don't care about the decrease, you can or the increase, this is really going to benefit you. But for like these people that already started stakes in this like sweet spot, that's tough. But like no free lunch, longer pays better, bigger pays better, and this is just part of the game theory. Like this is the reality of it, and so it's gonna be really exciting to see how it plays out. And that's probably what's been I think that like I'm not the first one to think about this. So I think this could be accounting for this like big increase in the price that we've seen over the last couple of weeks, is that the market is now adjusting this new reality where because literally it was on March 8th when this announcement was made that April 15th was going to increase S-load cost, and pretty much right after that the price started running. We've gone up 100% since then. And so on March 8th was when they announced that this was actually going to be rolling out. It started showing up in the test net, so everyone knew it was real. Cost of ending stake increases by 3x, and now the price has doubled. So we've already made up a lot of that ground already. Like that's going to be the saving grace. That's like again the big takeaway here is that if you're one of these people that has your stake, if you're one of these people that has, your stake is ending and it's going to be, too small to end stake, you're really hoping for gas to go down, hex price to go up, ETH price to go down, or hex APY to go up. And so hopefully all these things happen and not so many people get stuck, but there's kind of really no way around it. Like this is going to happen, and I think it's going to hurt a lot of people. But their loss is potentially someone else's gain. So that's just that's life. And now like you just have to factor that into like your future actions. So like other like kind of big takeaways from this are that like that like minimum value, like absolute minimum value of hex stake is probably going to be around 20,000 hex. So like if you have less than 20k hex in a single stake, just hold it liquid. Like truly, like if you're trying to stake 20,000 hex for a year and you're trying to gain like say, okay, so you're below average, you're probably going to be earning like 20% interest. You have 20,000 hex, you're trying to earn 4,000 in interest, and you're gonna have to pay a big fee to do that. Like, and so you're pretty much gonna break even. Like you're not even gonna break even because you're just gonna pay what you spent. Just look for a pump. Like I know a lot of the ethos around hex is like not to trade, but buying high and then trying to sell, or selling high and then trying to buy low to try to make up for interest that you're not earning by not staking. Like that's a totally valid strategy that doesn't bear that. Every day that goes by, it costs a little bit more to end the stake. So maybe we're going to see a lot more of that, which so what that means is we're going to see more volatility. And volatility is good because it gives buyers the chance to buy low. Like anytime people lose money trading, what that means is that they're either pushing the price up higher than they should be, or they're pushing the price down lower than they should be. And that's beneficial to everyone staking, because if like there's constantly massive volatility in hex, there could be days where it becomes feasible to end your stake. Or if you end your stake at a loss, maybe a couple days later, the value of the hex makes up for the amount that you lost by ending your stake at a very expensive time. So, like, I think that this is actually a really good thing that it creates the demand to generate that yield from trading and not just from staking. So it's going to increase the APY because more people are going to be holding HEX liquid to trade. And it's going to increase the volatility, meaning that there's going to be better buy opportunities and then better sell opportunities. And so overall, like this may be the biggest blessing in disguise for the HEX economy. This EIP 2929 that increases the cost of staking by 3x. I think this is like a really good thing. Kind of like how the Bitcoin halvenings, they make the cost of mining go up 2x. And that always kicks off a bull run because it becomes more scarce and more valuable to mine. I think this is going to be the exact same thing that happens with us. And so, like if you're in this category of people who are probably going to get priced out of your HEX stake, I wouldn't count on like a fork or like a new airdrop to like make you whole. Like the market's not demanding those things. The market's demanding HEX. And the people that are like really pushing the price up and like really demanding it, like they don't care about this price increase. To them, it benefits them. Like I wouldn't put all I wouldn't put all your hope in like a fork like suddenly saving the day and making you whole. And so but like this, like because this is happening. And this is such a bullish thing for HEX because it's like a half inning, but more like a third inning where it becomes, like 3 times as hard to stake. This could really push the price up in a big way that counteracts the effect that this increased transaction cost has on you. But I mean, even still, like smaller stake, like if you only have a little bit of HEX, just don't stake. Like there's really even longer, like still like you may be better off just doing, just not even staking and just playing the volatility. I think that, because the staking is such a valuable thing, and it's in such high demand, and then other things that take place on the blockchain are also in high demand. That's just the reality of it where, like if you're below the threshold where it's reasonable to participate in this economy, then, you're just not going to be able to. And, that's just the reality of this economy. So, we'll continue to monitor how this is going to play out. This, really, really bullish for HEX. And I think going to be a really, this may kickstart, HEX really becoming a major force, kind of this extra constraint on the cost of staking. This, while it sucks for these people overall, I think this is going to be a really, really powerful thing for us. Let's see if anyone else said anything in chat. The fees to buy are just currently awful. There's a minimum buy order unless you set a limit order. Yeah, so, it's the case for buying too. Like, let's see if we can take a look at the... So, okay, I don't have enough. It's not going to let me. We can just look at the gas chart. Yeah, so Uniswap, like right now, a Uniswap transaction is going to cost you $62. So, like, if you're buying less than $62 of HEX, like, just hold your ETH, like, because you literally, like, you're not going to get anything. So, like, a way to think about this is like, so probably the minimum purchase, you probably want to keep this fee to be like just the swap fee. You want that to be less than like 5%, maybe 10% of your thing. So if that's 5%, so times 20, like the minimum purchase that I would recommend making right now is about $1,200. Like if you have less than that, like just hold your ETH. I mean, ETH's probably going to go up too. So don't blow it all on this. Wait for this to go down a little bit. Sometimes this goes down just like on weekends at night. But like that's just the reality. Like we're on a valuable blockchain, and so we got to compete with other buyers for that block space. And so, just like if you want HEX, then get a second job. That's like the other solution to like just like the solution to all problems is increase your income. Like that helps push you out of the people that are so affected by like these per transaction costs that don't care how big or small your transaction is. Just get more income, make more money, ask for a raise, learn new skills, become more valuable, be a hero at work, and sell yourself. So that's really, that's like another solution to all this, is just, make more money so that you can afford to transact on the blockchain where all the opportunity exists. Because that's really, like, no one's going to give it to you. You got to want it. All these people, like, whenever you complain about transaction fees being too high, that means just someone else just wants it more than you. Someone else wants that block space more than you do. So, and they're backing it up by proving that they're paying more for it. So that's just the reality of this. What's up, Daniel? What's up, Alton? How many Doge for Hex bucks? I don't know. We'll have to look at the exchange rate. Buy sells gas free if you set a limit order. Yeah, that's right. So you can decrease that by, by first moving into WETH and then placing a limit order on some of these. Where if you place a limit order, the person placing the market order that goes into your purchase, they're paying the fee. So that is one way to save in a big way. Main issue with gas price when it comes to staking. Yeah, that's 100% true, especially on the end stake, because every day that goes by, it increases a little bit. So what would be a 15-year stake, 15 times value? Yep, literally, that's it. So for a max length stake, so if everything remains the same, the minimum viable end stake for a max length stake is 343,000 hex. So principal plus interest. So ideally, in that longer stake, you're earning way more than that. Like, even if you staked 100,000 hex, you're ideally earning more than that. But yeah, that's totally what that's like the reality of it. So let's see what the cost to end a stake is on a cost to end stake on that. 2.74 ETH. So literally, like, if everything remains the same, which you don't know what the gas price is going to be, you don't know any of that. You might need to save up 2.74 ETH to end your stake in 15 years. And at least you have 15 years to do it, because like you don't know what the price of ETH is going to be, but you know that like the gas is it's denominated in ETH, so that's what it's going to be. So maybe for these max length stakes, like just between now and then, like per stake, just try to save up that much ETH. Maybe that's just how you can guarantee that you're going to be able to end your stake, or at least like at that time you can assess, or even in between now and then, you can assess like, okay, I'm saving up ETH with the intention of ending my stake, but if the price of Hex goes down, like if we have a dip in the price, maybe I'll just buy more liquid Hex. So you can like increase the tolerance that you have to be able to like, let a stake bleed, because, in that time you have accumulated more Hex than you would have got by ending your stake. Or, you can like buy Hex when it's low, and then maybe when it's time to end your stake, you can, have some liquid Hex that you can then sell for ETH that you can use to end your stake, so however that may be. And maybe this is all opportunity for like financing solutions. If this is a problem where people can't afford to end their stakes, but they think that the value of the Hex is going to go up in time, maybe there's opportunity to provide lending services to those people, where you're lending them Ethereum so they can end their stakes, and then you're taking possession of some collateral, and then maybe they have to like give up their private keys to you so that you can manage, like, where you're the one, they give you the seed phrase. You go in there and, with a smart contract that you write, you end the stake and instantly transfer the principal and the interest to a wallet that the lender controls. And then, like, as they make payments, they free up some of that collateral. Maybe that's what this will be. Anytime there's a problem, like, that's entrepreneurial opportunity. And so in this case, maybe there's going to be entrepreneurial opportunity for lending services to emerge that help people finance their expensive end stakes. So yeah, assuming the price of it, that's the key thing for all these. So like, say for the cost to end a stake is that high, but say that in between now and then our price goes up 10x measured in ETH. Now that minimum viable end stake is going to go down. So like, still, like, that's the saving rate. That's like the big driver, is if the Hex price goes up. Like, you want the Hex to go up so that even if you're paying 2.5 ETH to end your stake, that's, a fraction of what you earned with your interest amplified by the increasing price. Price prediction for end of year is 0.56. Okay, let's see if the price is going to be 0.56. Here, we'll do this. So current hex USD. We'll see what this minimum viable end stake in dollars, or in, yeah, so wait, did I do this right? Okay, I didn't do that right. I don't want to break this further. Current ETH to hex. Okay, so I mean, just you can just scale that. So current price, that would be like 50 times where we're at now. So then you can just divide the minimum viable by divide that by 50. So knock off a 10. So like 700. Yeah. So like that really pushes the minimum viable and stake down. It's just like that price going up. But if like the price to measure here is the ETH to the hex to ETH pair. That's really what you got to look at in this case, because that's the main driver, because like the fee is paid in gas, and that doesn't care what the dollar price is. So you just got to keep that in mind. Hit those likes. Yeah, thank you, Nate J. What is the best way to purchase hex? Cheaper to go exchange. Yeah, I mean, you have to bear the risk of decentralized exchange, but if like that really, like $100, if it's just a couple $100, like that really doesn't matter. Just, I think Bitcoin.com does it. Hotbit. I don't know. I don't even really know who the decentralized exchanges that do hex. Great idea. Start a hexline. Yeah, that's literally a potential solution. So yeah, I mean that's kind of all I had today. I really wanted to dive in and really kind of get a better idea. So key takeaway, so the rule of thumb, like right now, like the absolute minimum, so minimum viable hex stake for about for a 1 year stake, the minimum is 1,600. That's where you would purely break even. So that's like a break even. So you don't want to do that. Maybe you don't even want to pay 10 times. So I don't even want to pay 5% of my hex in a fee. So I would do that times 20. So add a 0 and then double that. So I really wouldn't do a 1 year stake that's less than 320,000 hex. If that's you, just hold it liquid, because you really don't want to be cutting it close, because then it's what's the point? Hex is so volatile that there's always price pumps that you would have made more money selling into a pump than just earning that interest and having to bear that cost. So I think you'll end up with more hex just by keeping it liquid and then buying more hex, rather than staking your hex and then having to pay to unlock it, to earn some amount. You could just earn more hex by just keeping it liquid and then just, getting a second job and then buying more hex. Oh my God, Jay, everything says, I convinced a coworker last week to stake 1 share for 3 years. What about, yeah, I mean, you got to get in that. Honestly, I mean, the T shares, you really got to be pushing hundreds of T shares. Because those fees are just gonna eat into you, and all the people that are below that threshold, they're really just paying the people who are above that threshold. So a way to protect yourself is you can bear the 3.69% inflation that you're otherwise paying them. You don't want your coins to bleed out into them, because then it's you're not paying the 3.69% inflation, but you're paying 100% of your stake over the course of 2 years to the people that could afford to end the stake. So, holding liquid is, totally a good solution in this case. So yeah, thanks. If anyone else has any more questions. Oh wait, someone actually did ask me a question that he wanted me to talk about on the. Let me take a look. Where is this guy? Okay, here we go. He asked me. Okay, so he says, could you go over this scenario? For people that don't have very much money but were able to get a few million hex back when it was cheaper, having a 2 million stake on constant yearly rotation, getting that interest from the 2 million, then staking that 5,555 days. So that's a good question. Let's take a look here. So say right now we're getting so say you have 2 million hex and then you want to stake for 365 years, 365 days. So you're getting, so for this example, you're getting, what did that say? Let's just move this down this is the window and let's open that there. So for this example, you want to see if 2 million, so here, so we're looking for 2 million hex staked for 1 year, roll interest into max length stake. So let's see if, so for a 2 million hex stake, and so for 365 days, so here in this case, the minimum viable, okay, no, oh, that's why. So at the current price, we don't know what the price is going to be. So that minimum viable stake is 22,000 hex. So like right away, like right off the bat, so divide that by 2 million, you're already like 99% greater than the minimum. So like, you know, you're probably just already in the clear if you have 2 million hex to stake. You know, that cost, you know, may not be that big of a deal for you. You know, it's 0.18 ETH, so that's like $400. You know, that's really not that. If you have, so 2 million hex times the current price. So if you have 2 million, so 123 times 0.016 or 17, it's like you have $34,000, 400 over 34,000. Like that's only 1%. So like already, like that's you don't really care. But you know, over that time, so say you're getting 139.6 T shares times, and say that we expect the average daily payout to be, you know, just where it is, 5.8. So here your number of share days is, so you're getting, what did we say it was? 139. So 139 times 365. 139.6 times 365. That's the number of share days you have. That's what you need to think about. You don't think about shares, you think of share days, because like you could have a lot of shares that are only active for 1 day, but like the full comprehensive is share days. So if the average cost, so average earnings per share day over the duration of that stake is say 5.8. So that means that your average earnings times share days equals that stake is going to earn about 295,000 hex. And so for a fit, and so the goal is to roll that into a max length stake. So here, if we say, so now we're going to roll that over into max length stakes. Let's see what the minimum viable stake at the current price is. Again, we don't know the future price, but just at current price, the minimum viable stake for a max length stake at current prices is 343,000 hex. So like that's the value of your interest plus your principal. So over that time, say you think that you're going to make 50% per year. And okay, so that's the earnings, and then plus your okay, so that's how much you're going to earn. So if you roll that into a max length stake, you're a little bit below this minimum viable, but over that time, your interest is probably going to exceed that. And so doing this is actually probably an okay strategy to do a max length stake for for that principal. But but the thing you're really hoping for is that there's really high APY and that the price of hex goes up. I mean, again, like hex price going up solves all these issues. But so like of that, so like if you expect that the amount of principal plus interest is going to exceed what the minimum viable end stake value is at the current price, I mean, if our price goes up a lot, this is going to go down a lot, and like you're already way in the clear. So, that's that's like those are the levers that drive it. But for that particular use case, that may be a good solution, because here's the thing: like if you're, you have the 2 million hex, and you're earning that on it, so that times point, let's just say the price remains the same. So you're earning $5,000 on that stake. Like even, another solution is like now you just hold this principal liquid. And what you do is you wait for a pump in the price. And so maybe you wait for that to go up to 0.34. And now you have $10,000 of this principal. And then maybe you take, half of that, and then you do it in that long-term stake, because like you're still going to be close to that like minimum threshold. And so I think that this is going to continue to grow in importance. Keeping some liquid hex and participating in the swings, because that may be how you free up the capital to be able to like guarantee that you're going to be able to afford to end your stake. And so, like again, these are all like this is all a personal decision. You have to understand that you're, that you're going to be, you have to make the decision for yourself. Like I don't know your personal situation, but what he suggests, his idea of like keeping a revolving stake ladder and then just staking the hex. That could work. You're probably not going to lose out there, and where you lose on like the share rate, you're gaining in the ability to seize opportunities as they come. Like price could pump 5x in a day, and if you're liquid, you can sell into that, and then like being able to sell into a 5x pump on a day, that's the equivalent of earning 500% interest on a stake, which you might expect over a 10-year period, and so. That's, like that's just like the trade-off is like you can guarantee earnings by staking, but you bear the future gas cost, or you can not bear that gas cost and be at the mercy of the pumps and the dumps. So like, just like for your own situation, based on like your own aptitude and like what, your risk appetite is, that's just what you're going to have to factor in. But like this increase, it is significant, and so it really can't be ignored. And so rule of thumb, if you're going to stake, just do a max length stake, because like you get more like that really can help you, like the principal that you're earning on the max length stake, especially in those last 5 years, that can really that may even fully take care of the whole issue for you in its entirety. So like doing that, just buying more hex, continue to support your own price, that can help make your hex more feasible to end stake. And just like, rather than being in a rush to like if you're buying hex on a regular basis with like your paycheck, rather than buying and then staking, just like buy and hold liquid and just continue to build up your liquid reserves. And then you can have more flexibility with like being able to have more where you can afford to have shorter stakes, or you can, like have, where you can seize opportunities when there's like good sell opportunities, which like, just look at the chart, like there's always a good sell opportunity. So yeah, that's kind of what, for that example, that was a really good question. Let's see what. Great info, sir, but please update your Chrome browser. What's wrong with the Chrome browser? Huh. Hey, Hot Dog, I saw you have countless stakes. Do you have any problems bleeding out? Yes, some of them are free claims and kind of small. We'll see how the fee situation, the progress of the new fork. I don't know, dude. Like, don't have expectations that a fork is going to save those. Like, hate to break it to you. Like, hopefully it does, but like, you don't want to set your expectations of that happening, because that just may not be the case. Like realistically, like the honest truth. Yeah, and thank like it take like there's no shame in, like if you have like I think Hodl Dog must have a hex staking ladder with like a bunch of baby stakes, and a lot of people do. I've seen people share their pictures of it, and at that time, no one knew, because at the time when people were setting these stakes, there wasn't as much demand for the Ethereum network, and this change wasn't, for certain. And so people were very they were like, oh, it costs pennies to start a stake, it must cost pennies to end it. They didn't know. And so, these are the risks of being like a pioneer on like the forefront of these like new financial products. Think about all the people that were crossing the great frontier and died of dysentery, right? Like, that's kind of what, that's kind of what the people that had like a bunch of tiny hex stakes that are now non-economical to end stake, like he died of dysentery on the Oregon Trail, and that just might be how it goes. But the other stakes 6K higher, so those should be good. And yeah, literally, like, so the people that maybe lost out on their stakes that are going to just bleed out, like there were so many airdrops that Hexkins had, like all the uni, all the 1-inch tornado if you got it, like literally all these things. So, you win some, you lose some, and that's just like the nature of the game. Like we're in uncharted, like truly this is uncharted territory. Like there's no guarantee. The only guarantee in Hex is that the Hex contract will pay out at a rate pro rata, 3.69% inflation pro rata to the stakers per share, like per share. So like that's the only guarantee. There's no guarantee what the gas price is going to be. No guarantee what the cost of certain functions on the Ethereum network are going to be. No guarantee what the market value of that earnings is going to be. And so like there's the only guarantee in Hex is the 3.69% inflation, and like this is uncharted territory. Like there was no way to predict that we would have an abrupt increase in the cost of ending stake that had nothing to do with Hex, and because Hex is immutable, like it's a complete product, like there's no adjusting, and so like that's just the risk. We can't have 360x reward without massive risk involved, and sadly this risk disproportionately impacts the people with the baby bags of Hex. But that's just like real, that's life. If like the only way to prevent that from happening to you is to increase your income outside of this. Like if you're disproportionately affected by this, just make more money. That's really all you can do. Smart Hex scan, thank you. Typed Emotion says, if I have a stake expiring just after the balloon fork and it's only 150 haircut to early end stake, is that worth it? I would make sure that I would take a look at how if your stake started before big payday, I think that could have a big impact. So if You'd have to look at what your penalty would be. I think there's some tools to help you calculate that, but you know, I would take a, so here's what you should do. As it's leading up to April 15th, go to let's go to the hex contract. Let's see if we can find some. See if we can find, yeah, so here's an example. So go to a transaction like a couple days before the April 15th when this takes effect. Go to an end stake, click to see more, see how much gas was used by the transaction, find that address in hex.vision, like search for that stake, and then make sure that you're like, and then so like it'll tell you how much gas was used by the transaction. Multiply that by 3, calculate how much gas, like so that times like what you think the gas price is going to be. The gas price is what's shown on like the main page of Etherscan, and so calculate what the gas is going to be for ending that stake, and then compare that to how much the gas, I mean, it's still going to be high gas on that end stake, you know, plus the penalty. So if you have big payday, it may not be worth it. If you don't have big payday on that stake, you know, it all depends. It's too hard for me to calculate right here, but yeah, that's what I would do. I would look at stakes ending at that time, look at what they paid, multiply that by 3 for an equivalent stake, and then compare that to what you think your penalty is going to be. And I think Staker app tells you the penalty. So that's what I would try. Good question, though. 14 days till penalties kick in. After you lose 1% per week. Berlin Fork, 3 extra fees, Bermuda hold and then early. I can't say it also pay out for my stakes until Pulse Chain will end out. Yeah, I mean, I don't know, dude. Like, you like... Just don't get. I mean, obviously, like I'm rooting for Pulse Chain to be a massive success, and I think it will be. But Pulse Chain can be a massive success even without somehow making up for losses to bleed outs. So that just might be a tough. Holodox is the update button is orange. Oh, I don't know, dude. I never download anything. Like if something tells me to update, I'm like, nope. Maybe I should. What a cruel analogy. Yeah. Oh, is he talking about dying of dysentery? What? Oregon Trail die of dysentery. You have died. Yeah, literally. This is the hexagons. These are all the, let's make a meme right now. Oh, shit. Literally, this is the copy image. Small, short hex stakes. You have died of dysentery. Yeah, this is our new reality that we live in. Do I trust Staker app for stake started before big payday? Says I only lose 150. The stake was 100 principal, and now it's like 3,000. Okay, dude. Yeah. So I don't know if Staker app factors in that the big payday penalty. So I try some maybe ask that in some of the chats, and someone will be able to give you some more information on that. Oh, so he says he thinks he is better off early. I don't know, man. Honestly, like, you should just do it and tell us what happens, and then that'll, like, if you're already at risk of dying of dysentery here, then you might as well just be a test dummy there for us. Okay, so What else? Is there anything else to cover on this topic? Does anyone else have any questions? Let me see if anyone on Twitter. I think the guy had asked another question here. No, so I think that's all I have today. I think. So thanks for everyone who joined us. We had 17 people watching it through the whole time. That's pretty cool. Thank you all for taking the time out of your Friday. And so if you have any more questions on this topic, just hit me up on Twitter, Telegram, you name it. And then we'll continue to be monitoring this, and as new ideas come up or like new information emerges on this topic, you'll be able to hear it here first. And until next time, thank you so much. We'll talk to you all soon.